gold's a good investment. It's stacked up very well relative to the stocks in the long run. There are periods of time when it's underperformed, and there are periods of time when it has outperformed. And over the long run, it has been a far superior investment than stocks. And it has outperformed the dollar since the dollar and gold had their fixed $35 an ounce level. Good morning. It's Jeffrey Christian of CPM Group. It's about 10:25 in the morning of Friday, the 19th of May. I want to talk a little bit more about gold and silver prices. They've come off in the last couple of days in relationship to the debt ceiling. And then I also want to talk a little bit about long-term gold and silver purchasing power, since that's a subject that has been bopping around the internet. Gold and silver prices have come off sharply over the last couple of days. As with other financial markets, they seem to be reacting to the idea that there will be some sort of resolution between the Republican and the House of Representatives and the Democratic White House on a debt ceiling agreement. There are any number of ways forward, and it's become clearer, I think, across financial markets that the U.S. government is unlikely to default. I still agree or believe that there has been damage done to the credibility of the U.S. Treasury just by virtue of the stupidity of the impasse that has been happening. But it's something that we have to deal with. In the environment and the expectation that perhaps as early as today there'll be some sort of agreement to raise the debt ceiling and avoid further embarrassing behavior on the part of Congress and the White House, gold prices have come off sharply. People have been surprised. If you look at the chart here on the left, this is the gold price, and you can see that the gold price was down around $1,800 at the end of February. It rose sharply first because of the bank crises in March, and then it rose a little bit further over the last few weeks because of the debt ceiling impasse. The price has come off. It's come off and given up everything that it had gained in the last week or so, and it is now moving down lower. It's around $1,965 as we speak. You can see that the price was a little over $1,800 at the end of February, so it shouldn't be too much of a surprise. Similar price behavior in silver. It rose during March. It rose a little bit more earlier over the last couple of weeks, partly over concerns about the debt ceiling talks not moving forward or the absence of debt ceiling talks. Now that it looks like that silly little issue is going to be resolved, you're seeing the price come off. We are now into the middle or the second half of May. We are into the middle of the second quarter of the year. Seasonal weakness in fabrication demand for gold and silver often combines with some weakness in investment demand for gold and silver in many parts of the world at this time of year that causes the prices to soften during the summer. There's seasonal weakness in gold and silver prices in the summer months. We have been saying that we thought that we would see that again. We are seeing signs of it. We're seeing signs of weaker and lower investment demand in China, India, the United States, Europe. It's probably a seasonal thing and a passing thing. Our expectation is that by the end of the year, economic conditions will be driving investor interest into gold and silver again, and we'll see the prices rise. So that's sort of our market. Now, I've been hearing some comments about gold and silver being bad investments and not holding their value. And I want to go back and revisit these things. This is things that we've talked about before. This chart is the dollar's purchasing power going back to 1800. And you can see that the purchasing power was extremely volatile during the free banking era of the 19th century when we didn't have a central bank and it was really the Wild West, although it was the entire country, you would see the value, the purchasing power of the dollar fluctuate sharply. It peaked really in the golden age, the bell epoch of the 1890s, came down sharply. After that, rose a little bit during the Great Depression and World War II, partly because of the relative strength of the U.S. economy and the U.S. government compared to the rest of the world. And then it's been falling sharply. I point out 1971 because that's when the dollar's relationship with gold, the fixed $35 an ounce gold price, ended in 1971. And you can see that the bulk of the deterioration in the dollar's purchasing power from 1947 or so into the present, the bulk of that decline was prior to severing the tie with gold. The dollar has continued to decline since that time in terms of purchasing power, but the bulk of it came under the gold standard. So all those people who say that we have to go back to a gold standard to stabilize the purchasing power of our currency don't know history. It's very important to understand that currencies and quasi-currencies, which means gold and silver, currencies lose purchasing power over time. They do that for two reasons. One is inflation, and the other one is interest. If you earn interest, or if you can charge interest on things, then you have a slow deterioration in the purchasing power. By virtue of interest, you're in essence creating more of that currency out of whole cloth, and that deteriorates and depreciates the purchasing power of the existing currency stock. So over time, currencies and quasi-currencies like gold and silver lose purchasing power over time because of those reasons. It's true in the dollar. It's true in every other currency that you can ever look at. And it's true of gold. These are real and nominal prices back to 1700, and they're in 2022 dollar terms. This is from our gold yearbook, which we released in March and which you can purchase for $160 at cpmgroup.com. And you can see that in today's dollar prices, gold was more than $5,000 an ounce back in 1700. So gold purchasing power has not been stable. It's depreciated and deteriorated over the last 4 centuries. It has risen since it was freed from the $35 an ounce level. Now, part of that's not fair because you can see from the nominal price, the price of gold was fixed by government diktat or fiat, nasty term, for most of the period of time from 1700 into 1971. It was only really in 1968 that the U.S. government started allowing the gold price to fluctuate against the dollar. It was, I think, around 1966 when the British and the Europeans allowed it. So the gold price has suffered in terms of real gold prices or purchasing power by the fact that the gold price was fixed. Once you freed the gold price from being fixed at different currency rates, then it started to appreciate. And you can see it's appreciated sharply since 1971, but it's still much lower than its purchasing power was over time. All those people who pick 2 periods of time and they say, well, in 1967 and in 2022, an ounce of gold would buy the same thing. That's true. But in between, it would buy a fraction of it or a whole lot of it over time because the price of gold and the purchasing power of gold fluctuate over time. It's not stable. This is the price of gold since 1968, the modern free gold period, which is really what counts because everything before 1968, the gold price was tied to various currencies at various times. And you can see that the purchasing power, the real value of an ounce of gold, has fluctuated from around 100 to around 900, around 750, not quite 800, in 2020 to dollar terms. So that's not a stable currency. That's not stable purchasing power. That's not a real gold price that doesn't change in terms of its purchasing power over time. And that's empirical evidence. You can believe whatever you want, but the empirical evidence will say that if you believe in a golden constant, your beliefs are inaccurate. Silver, the same sort of thing. We've seen the silver price in real terms fluctuate between, on this scale, 10 and 90. Not exactly a stable purchasing power. And then I wanted to show you this one, which is the dollar and gold going back to 1800. And you can see again, you've just seen these two things. Oh, I'm sorry, this 1800. You can see the extent to which the gold price has recovered since it was free to float. And in order to say, hey, gold really is a good investment, I throw in this one in. This is the gold price in real and nominal terms versus the S&P 500 in real and nominal terms since the gold price was freed to float in 1968. The blue lines, if you can't really quite read it, the dark blue line is a nominal gold price, and the lighter blue or gray line is the real inflation-adjusted price. And then the orange and yellow lines are the S&P. Over the period, the modern era of free gold prices, the gold price has far outperformed the S&P, both in nominal terms and inflation-adjusted terms. So gold's a good investment. It's stacked up very well relative to the stocks in the long run. There are periods of time when it's underperformed, and there are periods of time when it has outperformed. And over the long run, it has been a far superior investment than stocks. And it has outperformed the dollar since the dollar and gold had their fixed $35 an ounce level ended in 1968 and then officially in 1971. So when I hear people say, well, my gold investments haven't done well, maybe you bought high and sold low. I don't know. Maybe you just bought high. Maybe you only buy when you're in a panic. I don't know why some people would have bad performance in gold investments. I do know that over time, gold has been a very good, if not superior, investment to stocks and bonds. It has lost purchasing power, and it's regained it, and it's lost it, and it's regained it, because it's a quasi-currency, and that's what currencies do. So that's our view of gold. It's one of the reasons why we love it. You may go to our website. You may order that gold yearbook I mentioned that has some of these charts in there. The silver yearbook has the silver real and nominal price chart. The silver yearbook was launched last week. This week, I'm sorry. Time flies. You can read a bunch of other free reads and look at past videos and things on our website. Learn about CPM Group. Learn about the research and consulting services that we provide clients to help them make better investments in precious metals and commodities. That's all I have for now. We'll be talking to you next week. Take care of yourself, those around you, and the whole wide world.